Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a number of different things. We look at the valuation of the S&P on a historical basis and a forward-looking basis. We do a pretty extensive study of growth versus value. We want growth to be doing well during positive times. If value is doing better than growth, that's usually more negative times. Then we look at other markets within the stock market to see if we're getting any clues from those markets about how they impact the S&P. And then we look outside of the stock market at commodities and interest rates and bond prices just to take it all together because all of these markets interact with each other. No market exists in a vacuum. And there are periods of time when one market will really have a direct impact on another market, and then it kind of goes away and is replaced by something else. This is being prepared for Monday, January 27th. The first area is valuation, and this is historical valuation by looking at earnings reports that have already come out and then comparing them with what was the price of the S&P at that time, and that creates a PE ratio, price to earnings ratio. And we come up with static numbers between 10, 15, and 20. When we're below 10, the market is considered to be inexpensive. When we're above 20, the market is considered to be expensive. And that's where we're at right now, but we've been that way for many years. And you can look back and see times along the way that the current price of the S&P tends to go above the PE ratio of 20. Now, a lot of people kind of freak out over that and they call the market overvalued, but we don't use this as a timing mechanism. We just use it more for information. Also, that same basic chart is plotted with different events that have happened and then what the valuations were at that time. Then Robert Shiller took the idea of the historical PE ratio and changed it a little bit by smoothing earnings out over a period of time and came up with his own ratio. And that's coming in at 38.47. Well, that's also above that 15, 10, 15, 20 level. And the median is between 16 and 17. We're coming in at 38. So, yeah, you can say the market is overvalued, but it's been overvalued for a long time. So it's not like things are getting ready to fall apart. We can also see here the Shiller PE ratio at the start of a presidency and what it was over periods of time. And yeah, we're coming in expensive. Now, the market seems to like what's happening with the new administration, with all the changes and executive orders and real shifts culturally and things like that. But we have to keep an eye on the economy. Interest rates have been going back up. The market's not anticipating a recession right now, but that could change going forward. There are some people that I respect and listen to that think we might go into a recession. There's other people that I listen to that I don't really respect, and they think we're going to go into a recession. And the same can be true with those people that think we won't go into a recession, both that I respect and don't respect. I listen to those people not to do what they're saying. I just use it for perspective. And then I reach my own conclusions as to what's happening. And we have evidence to say that we might go into a recession, other evidence that says we won't. And we just watch the data as it comes out and just piece by piece reevaluate things and then see, okay, is this a problem with the overvaluation of stock prices? It hasn't been lately, but it could become a problem at some point. And the market, though, looks forward. They don't use earnings that have already happened. They use earnings that are yet to happen, going out into the future based on forecasts and projections. And in addition to the S&P, which is the red line, coming in now at 22.1, so that's above that 20 level. We also have the mega cap 8, that's the purple line, coming in at 30.4. That's expensive, but earnings are still projected to go up with this group, and they are really growing on an earnings basis. And so the market doesn't mind buying stocks that are already expensive with the idea that they're going to go up in value and become even more expensive. We also plot the mid caps and the small caps, which haven't really been breaking out, but they haven't been breaking down lately either on a price basis. The mid caps are coming in at 16.5. They're closer to that fair level or fairly value level, where small caps are at 15.9. The 15 level is where we market fairly priced at that point. But are the earnings behind these companies to justify their prices to go up? That's the big question. Then we look at growth versus value. I start off by just looking at value in an uptrend right now. And value is even in an uptrend itself. It's kind of lagging behind right now, but it's in an uptrend, which can help the overall market. Where we get insight is when we do ratios between growth and value. And this chart on the top shows how growth is outperforming. An inverse of that shows how value continues to underperform. Then we look at the indexes longer term here, showing how growth is outperforming value. Then we do an inverse, but a shorter term look. Again, just confirming that value is underperforming growth. So that's positive for the market. The ETFs that we look at show how growth is outperforming. Here's an inverse, how value is underperforming. Another look at the index, more shorter term, growth is outperforming there. We're getting confirmation across the board that growth is outperforming value, and that's positive. We also look at a growth versus value ETF. We have been pulling back into the rainbow here, and I show this in the daily video. We're not breaking down. It would be nice if this was to get a little bit stronger, but it's holding up, but pulling back right now. Then we look at the inverse of that same ratio, showing how value's been coming back up, but still underperforming growth. We look at the mid caps. Usually I look at the small caps. I have them in the wrong order here. But mid cap growth to value is looking pretty strong right now. Small cap growth to value also in an uptrend. S&P growth to value also in an uptrend. So these are pretty healthy signs for the market. Even when the indexes might be going down or something, these ratios can be going up, and that builds some strength into the underlying market. Keep an eye on inflation. First, by looking at a very long-term chart. This is monthly of the CRB index, which is commodities, and they're going up now, and we're starting to go back up. Commodities have been seeing a little surge lately, and we'll see a daily chart and a weekly chart in the weekly video, and we're seeing a bounce there, which could be inflationary. So we want to keep an eye on that. And we're bouncing back up when we look at the ratio between inflation and deflation in the CRB index, but the moving average continues to go down. So longer term, yeah, it's shifting around a little bit, but we haven't changed any of the long-term trends. But we are in an uptrend when we look at the daily chart of the CRB index. We want to keep an eye on this. The Baltic Dry Index, though, still continues to decline. This is another inflation measure for shipping products in the Baltics, and that seems to be under control right now. Inflation expectations are going up, okay, but we don't necessarily want to freak out about that. We can have a growing economy, and that's what produces inflation, and we can have earnings increase, and we can have stocks go up all at the same time. It's when they get out of balance with each other. That's when things become a real concern. We look at other markets, aluminum, which is still in an uptrend, but it's been pulling back to its 200-day moving average. Corn's really spiking up right now and actually starting to go into an uptrend. Wheat is still more or less in a downtrend, and we want to keep an eye on fertilizer just to see if that's really spiking up or really going down, and it's not. Oil, we keep an eye on that for geopolitical reasons and for growth reasons and inflationary reasons. We started to really go back up, but Trump is trying to promote the idea of oil prices going down. He's going to be talking to OPEC and the Saudi Arabia countries. There's this real push for drill, baby, drill, and let's become energy independent. And so that's having a tendency to push oil back down right now. We look at a gold to oil ratio. Now, gold was chopping sideways and starting to go up again here. And so it's going back up over the last few days, but we have been going sideways with this ratio. And then we keep an eye on the 10-year yield here. And then we do a correlation with oil, and they're pretty much neutral to each other right now. Not seeing a real strong correlation currently. We keep an eye on diesel. In fact, I just started reading a very interesting book about Rudolf Diesel, who invented the diesel engine. Um, it's kind of a mystery because he died a mysterious death that nobody's really been able to come up with the answer to, and it's kind of interesting. Plus, getting a lot of history. This all started right before the beginning of World War One in the early 1900s, but we want to keep an eye on this. This has been going up. 18 wheelers, railroads, and diesel is still heavily used in our economy. Gas going back up a little bit, but still in an overall downtrend. Heating oil going up, but still in a downtrend. Natural gas going up and starting to resume its uptrend there. Copper has been bouncing around quite a bit. Usually we use this as a barometer of the economy. There's another one that I use later on in the video. We're in a weekly uptrend. Here we've been a little more choppy, where we're still in a downtrend, but we have been bouncing back up lately with copper. We look at a copper to gold ratio. This has been declining now, going back to the middle part of 2024. That just means copper is underperforming gold. This is longer term, a copper to gold ratio. That's the black line where it's been coming down. And then just to give a little bit more context, we plot the 2-year yield in green and the 10-year yield in red. And they're going in opposite directions now. The economy longer term is trying to figure out, okay, what are we worried about inflation? Are interest rates going to keep going up? Are they going to come down? If the economic outlook is looking pretty good, then copper should be going up, and we've got gold going up. So there's a lot of things at play right now. Gold is in an uptrend and coming off of a recent all-time high here. At least it didn't quite set a new intraday high, but it's close. Silver's been lagging a little bit, but it did get back above its 50-day moving average. And then I look at the closing price for gold on top, and then in the middle is silver, and we see there's a pretty strong correlation between the two. So nothing really out of line there. We look at a gold to silver ratio, and then we plot that against the US dollar. That relationship is more neutral, where quite often they tend to have a pretty strong correlated relationship. So we've been seeing a pullback in the dollar. Gold and silver both are in uptrends, and that's why this relationship is actually going down. It's not as strong as it usually is. We'll see if that gets more in line with each other. The dollar is still in an uptrend, but it's coming back and actually dropping a little bit below its 50-day moving average. A continuation of a decline with the dollar would probably be positive for stocks. As the dollar was really going up, that was one of the reasons that stocks were pressured, in addition to interest rates going up. We look at the euro, which is really bouncing back right now compared to the dollar index. And then we also plot the Japanese yen, which is still going down compared to the US dollar. And then I break these out. Here's the euro. It's still in a downtrend longer term compared to the dollar, but it's really been bouncing lately. And here's the Japanese yen, which continues to be in a downtrend to the dollar, and the British pound, also bouncing back lately, but still in a downtrend. And I show this chart. It's the S&P, which is a weighted index versus an equal weight index. And I do show this in the daily videos. And when the red line gets way out of line with the bar chart, that just means the equal weight version, the entire S&P, is either outperforming or typically underperforming the S&P itself. And that's what we saw back in the fall, where the bar chart and the red line were pretty much in line with each other. Then we saw the red line coming down as the S&P was going down, but even though they're on different scales, the broader market was underperforming the mega caps. And we saw that in other indexes too. The NASDAQ 100, as we were going down, they held up better. Well, now they're starting to come back. We're getting a little bit closer between the two. And this past week, we did set an all-time high with the S&P, but we didn't see the mega caps really all that strong consistently throughout the week. And so we see the red line improving here as the rest of the stocks in the S&P are showing a little bit more enthusiasm. Then that same idea, but then we do a ratio. When this is going down, that means the equal weight is underperforming the weighted version of the S&P, and it had been going down, and now it's just slightly starting to go back up. We'll see if this can continue. We're looking not just for the choppiness day in and day out, we're looking for the overall trend of what's actually happening here. Stocks continue to outperform commodities, even though they've been pulling back and actually fell under the 200-day moving average with this ratio. But we'll see if that is showing some improvement. Here's an inverse of that same thing, how commodities are underperforming stocks, bouncing back up, but now possibly coming back down with the ratio. The Nasdaq 100, which is a little bit underperforming the S&P, the Nasdaq 100 has not hit another new all-time high yet. They're still doing pretty good. It's not falling apart. But in a really solid environment, we want to see this ratio going up like it is now, but going up instead of sideways to down. The S&P 100 was really pulling back compared to the rest of the S&P 500, the bigger stocks in the S&P. Now it's bouncing up off of the 200-day moving average with this ratio, and it's still in a longer-term uptrend. The Nasdaq, which has been doing quite well, it's continuing to outperform the S&P 500. The Nasdaq 100 is underperforming the rest of the Nasdaq, and this could be more broad positive because instead of just a few stocks that make up the Nasdaq 100, now we've got the whole Nasdaq composite that's outperforming, and that just shows more broad participation, even though both of them are doing well by themselves. We look at a ratio between the mega caps, really, really big companies, and the equal weight version coming down a little bit here. Didn't really outperform this past week, even though we've been positive with the S&P 500. We look at a ratio between small caps and the S&P 500. That's the red line. Small caps are still underperforming. The blue line is the S&P 500. Here's another look at a direct ratio between the two. And until we can get above these lines and see the lines produce a golden cross, small caps will continue to underperform the S&P 500 as they have been doing throughout 2023 and 2024. Now, there's been a lot of buzz around the robotics and especially AI part of the ETF here, and it had a good week, even though it was down a little bit on Friday. It's actually coming up out of the rainbow. Now, what's interesting though is when we look at a ratio between the robotics and AI ETF and the tech sector, we came right up to this 250-day moving average, and we have not been able to break out above that. And there have been other times when we hit about this point, and then things start to kind of fizzle out. It would be more positive if we broke above this black line here and then continue to go up in the process. So we'll just be watching this as it unfolds. Then we look at the advanced decline line studies, and I show this in the daily videos. We're showing some improvement. We're above the moving averages now with the NYSE common stock, S&P, and mid caps. We're just about on the moving average, excuse me, with the small caps, but we are improving after we had been declining. I look at traditional Dow theory, which looks at the Dow and the transports to see are they confirming each other. And we're not seeing anything all that drastic. The transports are underperforming, but I have other charts to show that. Then I include utilities as part of traditional Dow theory. Not really seeing anything all that crazy right now. Mega cap growth, this is the stronger area of the market, but we have not come back and set a new all-time high yet. Now we're still positive and we're above both of the lines and the lines are all going up, but it would be more positive if we could come back with this ETF and set a new all-time high. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together, still in an uptrend, had been pulling back, now is showing some improvement. The Wilshire 5000, a broad market measure, coming off of setting an all-time high. And the total US stock ETF also set a new all-time high this week and still looking pretty solid there. Low volatility stocks came down to their 200-day moving average and are bouncing up, but still underneath their 50-day moving average. These are more defensive, and these tend to perform better when the market's getting ready to go down. But when we do a ratio, these low volatility stocks are really underperforming the S&P. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and that's why we see a little bit of a disconnect when we look at traditional Dow theory. The transport's just kind of chopping along sideways, not falling apart, but not really showing any strength currently. And we look at a ratio between the transports and the S&P. Overall, we've been seeing a decline here. And then we look at a new take on Dow theory. Instead of using the Dow, we use the S&P, which set an all-time high on Thursday on a closing basis. And then instead of using the transports, we use the NASDAQ. That has not set an all-time high. So for the time being, this is a non-confirmation. Now, within a relatively short period of time, we want the NASDAQ to do better and come back and set an all-time high. And that would confirm the highs that we're seeing here. And then to break it down a little bit more, we look at an equal weight version of the S&P, which is not setting an all-time high now, and an equal weight version of the QQQs, the NASDAQ 100, not setting an all-time high yet, but still looking pretty good. And then a relationship between the S&P and the transports here. It's pretty strong. Where we've been going up with the S&P, we've been going up to sideways with the transports. The FANG index, this is another way of looking at the mega caps, and that's really strong right now. But we're coming up with the FANG index here to this shorter term trend line. And I've been pointing this out in the daily videos too. Is this, and I draw these lines, so they're probably not exact. They're not computer drawn. I kind of have to eyeball it. But we're coming up to this trend line. We'll see. Is that going to produce some kind of a problem? And ARK, since ARK owns so much of Tesla and Tesla's been doing good, it was down on Friday, but it's been improving here. We look at the all world ETF, which excludes US stocks. These are starting to go into a downtrend. We fell below the 200-day moving average. We're bouncing back up, but the blue line's starting to cross below the red line, which is a death cross. But when you take US stocks into account, clearly US stocks are outperforming the rest of the world stocks. Small caps continue to underperform the tech sector longer term here, even though we've been chopping sideways lately. And then another look internationally, we do a ratio between US stocks and world stocks, showing how world stocks are outperforming, and the overall longer term momentum is also positive. And this is a monthly chart, so this is longer term. Keep an eye on bonds, and what I show in this video is the price of bonds, which have been under pressure lately. In the daily video, I show the interest rate itself. Here, I just want to keep an eye on price itself. We look at the total bond ETF. We did fall under the 200-day moving average. We're trying to get back above the 200-day moving average now. And if bond prices go up, that means interest rates are going down. World bonds, though, are in a downtrend right now based on price. Here's a daily chart of the yields where we were going up, and that's when stocks were getting under pressure. When we started to fall with interest rates, that's when stocks started to go back up, but we've been just kind of chopping around to slightly higher with yields currently. This is a weekly chart, and we're keeping a real eye on the red line. This is Japanese rates for the 10-year. Now we have US and UK rates and German rates. Okay, we watch those. But last summer, when this started to go above 1%, that's what the carry trade, that's what produced that big down day that we saw on August 5th. Well, we fell back under 1%, and now they just raised interest rates in Japan, and that's pushing this up. Is that going to create another problem? We're just keeping an eye on that for right now. On a longer term chart, stocks still continue to outperform bonds. This is a daily chart showing how bonds are underperforming stocks. And we look at junk bonds here, still looking pretty solid. Corporate bonds, they've been under a lot of pressure here, dealing with their 200-day moving average. And if we stay down here, we could see a death cross with this based on price. And we look at the ratio between junk bonds and conservative bonds here, still showing that junk bonds are outperforming or more preferred right now. And the relationship between stocks and bonds. That's why I'm really focusing on interest rates right now because the correlation is really high between the two. We keep an eye on the 10-year yield, and then I have some fib retracement levels here, which we're right in between those. And the hope was that we might get down and break below that 4.5% level with the 10-year yield. We came close intraday, but never broke down below it. And now we're starting to go back up with the 10-year yield. And that could pressure stocks if interest rates keep going up. And this is a longer term look here where we're typically getting into a higher environment for interest rates after 40 years of enjoying a lower interest rate environment. The 30-year bond, also keeping an eye on that, it got close up to the 5% level and since has been backing down, but it's starting to go back up as well. Corporate bonds in an uptrend, but still dealing with their 200-day moving average, they're going to have to bounce up here pretty quick, or we might end up seeing a death cross here. And then we look at a ratio between stocks and the 10-year yield, where stocks have been outperforming, but as interest rates started to go back up, if you see right about here, this is when the Fed started cutting rates. And it kind of goes counterintuitive, but that's when longer term rates, 10, 30-year bonds, that's when longer term interest rates started to go up. And that's why we're seeing this coming down now. It would really help things if this ratio was to go back up. Junk bonds still doing quite well and preferred. People are willing to assume the risk to get that better yield, and they continue to outperform the more conservative government bonds on a ratio basis. Then we look at the volatility of bonds, which has been coming down, and the volatility of stocks, that's the VIX, also coming down, and there's a pretty high correlation between the two. And I always like to say here, this is not talking about price. This is talking about measuring volatility of stocks versus bonds here. Then we look at a ratio between the S&P 500 and short-term 1 to 3 year bonds. Stocks are outperforming. This is still looking pretty solid. Then we look at a broad market measure, the S&P 1500 with short-term bonds also doing quite well. Then another broad market measure with further out bonds looking really good right now. The tech sector doing good when compared to 3 to 7 year bonds. And this is kind of an inverse of what we just looked at. This shows how bonds are underperforming stocks. And then a long-term chart of the 30-year bond based on price, that's continuing to decline. And then we look at another ratio between the long-term bond and commodities that still showing that the long-term bond is outperforming, but we're starting to roll over here. But this is a monthly chart, so it can take a while to work this out. And then for some reason, I have another volatility chart here. Okay, then I go down and I look at the different sectors. There are 11 sectors that make up the S&P. And I just rank these on on alphabetical, um, how their symbol is shown right here, where materials are in a downtrend but have been coming back lately here. It likes the potential that the economy could be looking stronger, but they still are underperforming the S&P 500 on a ratio basis. Communication, this is a growth area. We want this one to be doing quite well, and it is doing well, and it's outperforming the S&P 500, even though it had been pulling back lately. Energy, which has just been going down, now has been going up. It's still in an uptrend. It's been really choppy lately. And but when we do a ratio, even though it improved quite a bit, it's still underperforming the S&P longer term. Financials, we want the financials to do well, and they are doing well. They were able to get back above their 50-day moving average, and they are in an uptrend and doing pretty good here when compared to the S&P. Industrials, another economic sensitive area of the market, had been under a lot of pressure, was able to get back above its 50-day moving average, but still has some work to do here to get a golden cross when we compare it to the S&P. Tech sector, this is another growth area, the darling of the stock market. This is looking pretty good right now. But the S&P's been doing well, and the tech sector is doing well, so we've been going sideways with this overall ratio. Staples, this is more defensive, actually falling under their 200-day moving average. And I was pointing that out in the daily videos, and then we were coming back up, and we never got to the 200-day moving average. This would actually be more positive for the market because this is defensive. And if these can actually start to go down because the economy is looking pretty good, then that gives growth stocks a better chance of going up. But we don't want these to fall apart either because these are still calculated in the indexes and they're still underperforming when we look at a ratio between staples and the S&P. Real estate, which doesn't like interest rates going up, that's why we were coming down here. We're starting to bounce back up. It's still under its 50-day moving average and continuing to underperform the S&P on a ratio basis. Utilities, which had been really strong, pulling back, came close to their 200-day moving average. Now they're starting to go back up now. And we are just working off of a recent death cross here with the utilities to S&P ratio. They've been chopping more or less sideways. Healthcare, another defensive area under a lot of pressure, now starting to come back, but still in a downtrend and continuing to underperform the S&P with the ratio. Utilities, we do a ratio between the S&P and utilities. We're not getting any real decisive move one way or the other. We really pay attention to this when it's really going up or really going down. And it's been pretty choppy lately. Discretionary, this has been the strongest area going back to the first part of August. This has really performed well. Amazon, Tesla, they're included in this part. Came down to their 50-day moving average and bounced up off of that. And it's been one of the stronger areas against the S&P, but we're coming back down to the 50-day moving average with this ratio. To stay more positive, we would like to be able to bounce up off of this. Semiconductors, keeping an eye on that. And I go through a number of different charts on an as needed basis in the daily video. This is the SOX index. Now you look at other semiconductor indexes and they're in uptrends, but the SOX index is in a downtrend, although it is improving and we're potentially breaking out above these previous high readings that we were getting recently. But semiconductors are a huge part of tech and we want that to do well. And then that helps the tech sector do well, and then that helps the S&P do well. Energy is still underperforming the tech sector on a ratio basis. Growth is outperforming more conservative bonds based on price. No surprise there, but it's what we've been seeing for quite a while now. And the tech sector, even though it was coming down under the 200-day moving average with this ratio compared to the 10-year yield, it would be more positive if we could go up here. If interest rates keep going up and outperforming the tech sector, we might be getting close to a death cross here with this ratio. And this is an inverse of that same thing, how the 10-year yield has been underperforming, but this could be changing unless we see some more improvement with interest rates actually coming down. Discretionary doing quite well when compared to staples. Staples underperforming discretionary here. The gold to S&P ratio still continues to pretty much go sideways, as both have been doing quite well. Neither one is really outperforming the other right now. And gold is outperforming the US dollar, even though the dollar had been strong. That's why we were seeing the ratio coming down. But now, as the dollar's been under some recent weakness, gold is at least holding up. And that's why this ratio is starting to go back up. This is another proxy that I use for the economy. High leverage loans, very risky loans. This ETF just continues to look pretty solid, not even really coming down to its 50-day moving average. If the economy was getting ready to fall off a cliff, this would be going down, not going up. The NYSE composite was able to get back above its 50-day moving average. That's a broad market measure. All stocks, US and international stocks, also looking really solid now. Emerging markets, though, some pressure here, actually starting to form a death cross. Not quite there yet, but getting very close. Keeping an eye on what's happening in Japan with the stock market just kind of chopping around these high levels. We keep an eye on the home builders ETF and a correlation between the S&P and the home builders ETF here. The correlation is pretty strong right now, so really no concerns there. Micro caps came down on just about to their 200-day moving average and have been bouncing up again. They're still hanging in there too. Bitcoin, which had a heck of a time getting above 100,000, then it dropped underneath it. Now it's back over 100,000. And then we look at international, and we use a long-term oscillator for this, where China is starting to turn back up. Emerging markets are starting to go up, trying to turn back up in Europe, and Japan's already going up, and we're starting to go up again in the US. So on a world basis, longer term, this is a much slower oscillator here. This is starting to show some improvement, but can it continue? Intermarket analysis. And I still am going back to the beginning of 2024. When we get to the end of January, there'll be enough to actually start to populate this on a shorter term basis. But we still have gold looking good, stocks, oil. This is the dollar, and bonds are still negative based on price. Then we keep an eye on some correlations, and we're actually seeing some opposite correlations right now. As stocks have been going up, the dollar's been going down. Okay, and that's helping stocks right now. And that relationship seems pretty strong right now. We look at the S&P 500 to oil also going in opposite directions. If oil's going down, that helps stocks to go up and vice versa. Now, there are other times when oil goes up and stocks go up at the same time because oil companies are having good earnings and they're one of the darlings of the market and all of that. But right now, we're watching it more as an inverse relationship with each other. And we keep an eye on the S&P to the 10-year yield, opposite directions. So if interest rates go down, that will help stocks to go up, and vice versa. If the 10-year yield goes up, that will probably pressure stocks. And we keep an eye on the 2-year yield, also opposite directions right now. Tech to the 10-year yield, opposite directions. And then we keep an eye on some long-term trends. This is a monthly chart of the NYSE. Still looking really solid. Not back to an all-time high yet, but doing quite well. And the momentum is still hanging in there, being positive as measured by the Copic curve momentum oscillator. Here's a daily chart with the NYSE record high percent index. It had been coming down. Now it's been ticking up lately. And so we're seeing some improvement on a daily basis. Then the S&P monthly chart, and then with the percentage price oscillator, we're seeing a little bit of vulnerability here. We're going to need to keep going up here for this oscillator to turn back up longer term. And then the S&P on top, and then a ratio between stocks and commodities here. Stocks are still outperforming. Another look at a ratio between US and world or global stocks. US stocks are outperforming. We're seeing the KST, the longer term momentum oscillator, starting to go back up as well. Then at the end, I list those things that are positive. And if you watch this video every week, there's been no changes here. There's potentially some changes in the works, but it's when the 50-day moving average is above the 200-day moving average. And so we have growth and value by themselves. The dollar's still in an uptrend as the CRB indexes as well. Gold and silver are in uptrends. The mega caps, the FANG index, ARC, the low volatility ETF by itself. It just underperforms when we compare it to the S&P. The staples are still in an uptrend, even though they've been pulling back. The Dow Jones Composite Average, bonds based on price, except for the World Bond Index that we follow. The tech sector, high leverage loans, the Dow, the NYSE, and Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, all stocks, US and international stocks there, emerging markets, and Bitcoin. So a pretty long list of positive things, a pretty short list of negative things when the 50 period moving average is below the 200. Copper still in a more downtrend right now. It's in an uptrend on the weekly chart, but it has to repair some damage on the daily chart. And even though the euro and the yen to a degree and the pound have been bouncing up against the dollar, they're still in downtrends when compared to the US dollar. And then when you look at the SOX index, which are the semiconductors, but yet we have other different indexes that we follow and some ETFs that we look at, those are all positive. And then the World Bond Index based on price. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.